Are you sitting on a stock with significant capital gains? I mean, like big capital gains. It's actually not that uncommon anymore. Maybe you're an executive in a company and you've been granted employer stock over time, or you inherited some, or you bought Apple shares for 50 cents a share 20 years ago. We call these highly appreciated, concentrated stock positions. Not a bad thing, mind you, a good thing, except for two potential issues: lack of diversification and capital gains taxes. You see, obviously, there's an inherent risk in having a large sum of money tied up in one company. But as we go to unwind the holding, we have to be aware of capital gains taxes. Now, over the years, advisors have come up with several tried and true strategies for tackling this issue. We can systematically pace out the sale over several years to keep the tax hit from happening all at one time. We could try to offset the gains against some losses you may have. If you're charitably inclined, we may recommend that you donate the highly appreciated stock to a charity. And we can get real fancy with things like options and collars to help mitigate some of that downside risk. But I want to talk about something you maybe haven't heard of: the exchange fund, not to be confused with the exchange traded fund. An exchange fund, sometimes called a swap fund, is a limited liability partnership or limited liability company that has been created by a financial institution. What you as an investor can do is elect to swap your highly concentrated stock for some ownership in this exchange fund. Now, exchange funds typically invest at least 20% of their assets in real estate, while the other 80% is invested to mimic an index like the S&P 500. The advantage to you as the investor is that the swap is not immediately subject to capital gains taxes, meaning you can get the potential benefits of diversification without the tax bill. This also means you don't have to worry that one bad news headline is going to make your stock value nosedive. For those of us who are advisors, you might be familiar with a real estate 1031 exchange or a life insurance 1035 exchange. It's the same idea, only for stock. So, what's the catch? First things first, there is a 7-year holding period. So, if you need this money in the next 7 years, this is probably not the strategy for you. Also, the limited partnerships do have to accept you and your stock. So you have to find somebody willing to take on your account. You must be a qualified investor. So typically we're looking at somebody with at least $5 million in investable net worth. And most of these exchange funds have minimum investment requirements to the tune of 500,000 or maybe even $1 million. The cost, there is a cost associated with it. Often a basis point fee to get into the partnership, and then probably some trailing expenses for ongoing management. Exchange funds are an alternative investment, and opponents do raise concerns over their lack of transparency because they're not registered with the SEC. But take the scenario of a high net worth individual with a multi-million-dollar gain in a single highly appreciated stock. If they don't intend to use this money for 7 years, this is potentially a solution for them to celebrate their investment success, but then diversify the holding and potentially delay capital gains taxes. And if we push the envelope even more and assume this is a portion of their estate that they never intend to use, if it were to pass to an heir upon their death, the heir would receive a step up in basis, meaning that your heir's basis in the stock is now the value of the holding on the date of your death, not what you originally paid for it. This could potentially restart the clock on the capital gains of that one holding. To be sure, an advanced strategy. If you are sitting on a highly appreciated stock position, give us a call. We'll be happy to help. That's it for this week. This is Jeannie Fisher, the 401k lady.